So, Dave, you were
Thank
talking about interest rates and clients and how fixed rates have changed over the last couple of weeks. So, tell us how those conversations have been going.
It has a huge impact on our clients when they hear that rates are moving, and it's totally understandable. So at any point in time, we've got lots of people who've got deals in the system at lenders already at different stages, whether it's just been lodged or they're about to sign loan contracts. And then we've got almost the same amount of clients who are on the borderline of signing a loan submission. So it probably does spook a lot of people in terms of, are they making the right decisions in terms of their loan structure, in terms of how much they are prepared to borrow, in terms of purchasing a property. So all these things stoke emotions in people as to whether they're doing the right thing. So the number of conversations and the amount of time we spend talking on these matters magnifies by a multiple of 2 or 3, and it's totally understandable, and it's time well worth spending with clients to take them through what the rate rises or potential rate rises might mean for them.
Because it's interesting, isn't it? Because people will agree to pay a price for a property based on quite often what those repayments will look like and that affordability. And so you go and change the rates on them too quickly, and that just messes with all of the decisions they've made since day dot, doesn't it?
It does. And yes, there's interest rates and there's loan structure, but what everyone wants to know is what the repayments are going to be, and that can sometimes be a complicated equation, especially when they might own more than one property. So ultimately, at the end of the day, people want to know, because they know what their net incomes are, but they want to know what their repayments are going to be and what portion of their loan repayments may go up or down due to rate movements.
Yeah, absolutely. So, somebody comes and sees you today, and I'll jump in on this one as well and says, all right, talk me through variable versus fixed and what we should be doing. What are some of the things that come to mind that you talk to your clients about?
It's a conversation that I have had probably 2,000 or 3,000 times, and I wouldn't even say I've perfected the response to that as to whether a person should fix, how much they should fix. But I have come down to probably one core reason why people should fix a rate, and that is because they want certainty over their repayments. But they see the rate now and they want certainty over that repayment level, and that is pretty much the only reason to fix. We would easily have as many people who have fixed at a rate that's too high than is too low. As soon as a client thinks they want to fix because they want to beat the variable rate that they might be paying, as soon as they feel as though they want to beat something and have a win, at that point we are entering an unknown territory, which is not far off going to the casino and putting money on red or black. That bit is a gamble, and I try and steer people away from that. The only reason they should fix is if they want certainty over their repayments.
Yeah, I heard I can't remember where I heard this from before, but this particular gentleman said, think of fixed rates like an insurance product, all right? So, and I think he might have been in the finance game at some point, and he sort of came across some research that suggests that if somebody just continually fixed over a 20-year period, that they would probably pay a premium over if they just went variable, all right? So, but that's okay because it's like an insurance product, right? Insurance costs money. And I think we've just come out of this season where, because rates have been either coming down or low for a long time now. Like it's been 3, 4, maybe even 5 years where we've been on this journey, and so there's a whole range of people that just don't actually know what it means for rates to go up.
I think the last RBA increase, it's getting on 10 years. Yeah.
Well,
so, I mean, some of our first home buyers, which might be 28 or 30, may not have had that experience, as you say, in their whole adult life. And of course, their parents, who may have, had their first home purchases in the mid 80s and have experienced 15-16% rates, it doesn't even take one whole generation to experience the two complete extremes of the interest rate fluctuation or cycle.
And I think for me as well, it's also taking into consideration that it's about the repayments, but it's also about, how much do you think you're going to be able to pay off the mortgage over the next 5 to 10 years as well, or not that long, 3 to 5 years, because, there's a bit out there in the media talking about, possibly wages going up a little bit over the next 6 to 12 months. So possibly people are holding on to a larger than normal amount of savings, and they need to be able to put that somewhere. And that's one of the things to be careful of as well, that you go and fix all of your loan for a long period of time, and you're taking away from that ability to knock a big hole in the mortgage, aren't you?
Yeah, that's true. That's true. Now, what are you finding in terms of, let's say, a first home buyer borrowing 600,000? What sort of appetite is there for fixing the whole lot? Many people wanting to fix the entire thing?
Look, I think it's naturally a question because a lot of people still don't really know they can split their mortgage. So they think they've got to take one or the other, and they don't realise there's an option to take a bit of both. So that's a question, do I just go fixed or variable? And then you explain to them that option. For me then, the way I normally guide them is to sort of say, look, we want to leave enough. If you're going to go partially variable, then we want to possibly leave enough variable that gives you a bit of room to move to be able to pay down the debt over the period of time that you've got the fixed rate mortgage for. So if you fix for 3 years, how much extra do you think you could pay off during that 3 years, and use it as a bit of a conversation piece to talk about what that split or that breakup might look like between fixed and variable.
Would you say that you would have more self-employed people or PAYG employees or government, private sector? Do you see any trend on who's more likely to want to lock in versus a floating rate, a variable rate?
I definitely think the self-employed person is less likely to want to fix. So depending on what sort of debt they're holding in other places, I find that it's the first home buyer that typically has the highest chance of wanting to fix. And I've just usually put that down in the past to it's because they've never done it before. This is the biggest amount of debt that they've ever taken on, and it's just so new that they want to minimise that risk somehow.
Yes, I find self-employed people tend to possibly be more of a risk taker, and so they're happy to float with the economic environment. And there is a theory with many industries, particularly in the private sector, that if rates are going up, there are many sectors where their pay is going up. And that's one of the things that's fueling the increase in property prices. So many of us in different sectors, not just finance, but many sectors, will be experiencing income rises or more bonuses during those times where the RBA has to lift rates and banks have to lift rates to curb the heat of the market.
So that's a good segue into probably what we want to talk about next, which is some thoughts around possibly where interest rates are heading at the moment, and I don't know about you, but that for me that in itself, I think you might have mentioned earlier on that that's a dangerous game to play. That quite often you can't sort of try and predict too hard on that. So for me, hearing the Reserve Bank a week or two ago come out with a bit of a different story about what they were expecting rates to look like over the next couple of years. Okay, there's a bit of an ingredient in there. You've also got this start that's happened over the last 2 weeks with fixed rates where a lot of the banks have started to move their rates already. But as you and I have seen over the last 20 years, sometimes rates go up, but then they come down again, don't they? And we've both experienced that. So, you know, is there any other information that you're hearing at the moment that's sort of giving you a bit of an idea as to what's going on out there?
I'm not, but I think as we return to normality coming out of COVID, I think the government will be very cautious in terms of not overly putting a dampener on things. I think coming off COVID, I think the major thing I think economists or people mispredicted was how steady the employment was. I think in lockdown number one, there was a lot of shock, there was a lot of concern. We were very busy in our office talking to clients about holiday repayments and settling people down, and I think the banks did a pretty good job in weathering that and dealing with customers in a very, very empathetic manner. And then we came out of lockdown one and things started really moving. Like most brokers in our industry were pretty busy at the back end of last year, and that has kept moving, and that has kept moving all through lockdown number two. And so the fact that people held their jobs has, I think, surprised a lot of people. So the heat in the market has just continued. But coming out of lockdown, there are so many industries that are on their knees that need to get back to normality. They'll want people spending money on tourism and holidays and hospitality to get all those very important sectors that employ so many people back on their feet. So I'll be surprised to see if there's massive measures to put big dampeners on spending, whether it be property, construction, infrastructure. I think we might be in this pattern for a little while.
Yeah, and you're right. There's just so many different industries with different stories. So, you know, we can forget sometimes how some of the other industries are going. You know, I know what's very topical at the moment is you know, society wants to talk about how we repay this debt and what goes on there, and obviously that's going to be a pretty tricky thing for the government to work out over the next season. So. You know, and we're coming out of lockdown at the moment, and obviously, you know, things for a lot of people are starting to get some sort of normality around them, but it's still very early days yet, and all it takes is a couple of blips in the marketplace, which we've seen before as well. It's been interesting to see, you know, tsunamis affect interest rates, or stock market crashes, or you know, a whole range of things that can come from a bit of left field that can actually affect interest rates. So whilst the mood in the market at the moment is that rates have started to move up, it's definitely not something where you know, we can be confident in what's going to happen. And I think, you know, it's really just comes down to the volatility of what's going on around us. The more volatile it is, the more uncertain and the more up and down things can be.
Yes, and it highlights the reason more and more that decisions that you make need to be done with a longer term outlook. So, yes, when things are pretty volatile, our job is to try and maintain calm, try and explain things as best as we can to clients. And sometimes, for me, that includes picking the time when you talk about fixed rates and all the pros and cons of fixed rates with clients. Sometimes there can be so much going on in a home buyer's life, whether it's their first, second home. There's so much going on. You've got to pick your time to have that important conversation, because sometimes in our first or second meeting, we're talking about things like purchase price, repayments, things like that. They're very focused on the actual property they're buying, getting approval in time, auctions, bidding, construction reports, pest reports, solicitors. There's so much going on that you almost have to find the right space and time to have the conversation about the pros and cons, the fixed rates. Because if it is something that we don't get right and the client doesn't fully understand and commits to a fixed rate for too long, things can work against them in terms of their ability to make extra payments or use offset accounts, or they intended to sell the property in 3 years and they might be staring at a break cost. And a break cost is an entire conversation on its own. So there are complexities with it. and it deserves its own time and space with a client to have that conversation.
Yeah, look, absolutely. So I guess just to try and sum up a little bit, I mean, look, the reality is hopefully what we've highlighted today is that interest rates are a complicated conversation. It needs a good conversation with the right professional to be able to work out not just whether you should fix or not, but how you structure your mortgage, and also the period of time that you fix. Even at the moment, Dave, I think there's probably, what would you say, about a 1.2% difference for some lenders between, say a 1 year fixed rate loan versus a 5 year fixed rate loan.
Right, and even a 3 year fix from one lender to another lender, that's different at the moment.
Yep, absolutely.
Yep. And if there's one thing Vision does very well, is we've got a fantastic Vision fixed rate fact sheet. Now that has been changed about 200 times over the last 10 years. It's succinct, and it's just got the pros and cons in very simple English. And if you click on the site, you'll see that at the top of the blogs. Please just take it and use it. Ask us any questions that you have. Even if you're not quite ready to buy a house, it's the product of lots of changes over the years, because some clients have asked too many questions because we've used too much jargon. So we've made lots of changes, and hopefully it's understandable. And please, even on the bot on our website, feel free to ask questions.